Hello everyone and welcome to Momentum channel. Today in this video I want to talk to you about the Wealthsimple socially responsible investing portfolio, what is so unique about it, and of course also walk you through the latest changes in this account and why I'm so excited about it. As you may know, the Wealthsimple Socially Responsible Investing account was introduced back in March of 2016, and it's been performing quite well. In fact, the annualized return for this account has been around 6.7%, which is quite impressive, showing a total return of 31+% since its inception. And as the name suggests, the socially responsible investing attempted to invest in companies that are more socially responsible. They are considerate of various aspects in terms of the environment, in terms of the human rights, and other aspects, and they are better run compared to other companies in their sector. Now, in essence, of course, there is a flaw in how to go about identifying those companies. Imagine, for instance, a company in the field of tobacco or gun manufacturing business. They might be the best company in terms of how they're run within their industry and sector, but that doesn't make them a truly socially responsible investing type, because at the end of the day, they are in a wrong business for someone who's interested in socially responsible type of investments. Which is why just today, Wealthsimple announced that they are making some massive changes to their socially responsible investing, which I personally love these changes. In my opinion, these changes are going to be very positive, and in fact are going to make the socially responsible investing portfolio of Wealthsimple stand true to its name. But on top of that, they're going to bring about positive impacts to the investors too. For starters, the cost for your portfolio is going down. Previously, the management expense ratio for the equity funds in the portfolio used to be 0.48%. But with these changes, it's actually going to go all the way to almost half of it, and is going to go down to 0.23%. And that is a considerable change in the cost for this portfolio. Wealthsimple has replaced many of the equity funds that were available in the old portfolio and added two major ones here. And these are the exchange-traded funds that Wealthsimple has put together. One is called WSRI, which holds North American companies, and the other one is WSRD, which holds companies in Europe, Australia, and Asia. And how they go about identifying these companies for two Wealthsimple socially responsible ETFs is quite unique. They're actually going to apply far more stringent filters how they pick the companies that end up in a socially responsible portfolio. So for instance, here are the type of companies that would not make their way into the socially responsible funds. The big polluters, such as oil and gas companies or companies that are in thermal coal business, they are going to be excluded from this portfolio. What's more, they've eliminated the top 25% carbon emitters in each industry from this portfolio. As a result, lowering the overall carbon footprint for the funds without sacrificing the diversification. Furthermore, companies that are in violation of the UN Global Compact for major controversies and human rights violation are excluded from this fund. Any weapon manufacturer or defense contractor is also eliminated. On top of that, companies that are involved in the manufacturing of tobacco products, alcohol products, casino, gaming, adult nightclub, and entertainment companies are also excluded. And lastly, companies that do not have women in their board of directors are also excluded from the fund. Instead, Wealthsimple will look into the companies that have diversity on their boards and walk the walk when it comes to progressive policies in the realm of sustainability and corporate governance. In Europe, that means a larger concentration on companies in Germany and Nordic nations, which tend to have the most regulation in those areas. And in North America, it means a wide range of companies in sectors such as financial services, real estate, food, and beverage conglomerates. Personally, I am invested in the social responsible investing account with Wealthsimple, and I've selected the high growth risk tolerance. As a result, close to 90% of my funds are invested in stocks and 10% in bonds. Now, given that my portfolio was just switched from the old ETF to the new ones that are just introduced to Wealthsimple, the performance might not actually reflect how my account has been doing, but you can see the number of shares that I currently possess in these new exchange-traded funds. I have about 33 shares of Wealthsimple North American Social Responsible Index, WSRI, also about 33 shares of WSRD or Wealthsimple Developed Markets, and roughly about 10% in government bonds. And we have two of them here, 6.7 shares of ZFL or BMO Long Federal Bond, and about 1 share of BMO Government Bond Index ETF, which is ZGB, a new addition to this portfolio. Are you invested in any social responsible account? And what do you think about that? Let me know in the comment section below. I hope you found this video beneficial. If you did, please hit the like button and subscribe to Momentum channel. Here on Momentum channel, we post weekly videos about stock market investing and finances. See you next time.